Hello and welcome to Financial Intelligence. In this video, I want to talk about ETFs and index funds. These two instruments are very closely related. However, there are subtle differences between them that confuse most investors. When comparing ETFs and index funds, each has its own advantages and disadvantages. My research shows that when considering ETFs and index funds, which track highly popular indexes, these advantages and disadvantages tend to cancel each other out. In other words, ETFs and index funds tracking major indexes tend to have very similar performances. In this video, I'm going to share with you a tool that you can use to compare and contrast popular ETFs and index funds offered by Vanguard and see how I arrived at this conclusion. If you like the type of content that I provide on this channel, consider subscribing to the channel and hit the like button and also the notification bell so that you don't miss any of my future videos. A disclaimer before we get started, note that I'm not a financial advisor. The content that I share on this channel is based on my research and is for educational purposes only. For professional advice, you should talk to a financial advisor. Part 1. Quick introduction to index funds and ETFs. An index fund is essentially a large pool of money collected from investors, which is managed by professionals to track a specific list of securities, such as stocks of the S&P 500 companies. When you invest in an index fund, your money is added to the pool managed by the investment firm such as Vanguard. In this scenario, Vanguard will take care of managing the fund and ensuring that it tracks the index in exchange for a management fee that they charge annually. Exchange-traded funds, or ETFs for short, are created based on the same concept, which is to track a specific list of securities, but they are implemented differently. In this case, an investment firm such as Vanguard creates a fund by purchasing the securities listed on the index. Then, Vanguard splits the fund into smaller chunks, so to speak, and starts to sell them to investors on stock exchanges. In other words, when you are buying a share of an ETF, you are buying a small portion of the fund that Vanguard has created using the process I just described. Part 2. Hidden costs associated with ETFs and index funds. Both ETFs and index funds can be very cheap to own from an expense ratio perspective. The expense ratio, or the management fee, is the annual amount of money the investment firm, in our case Vanguard, will charge you to manage the fund. These fees are explicitly called out on the prospectus of the ETF or index fund. However, management fees are not the only costs that affect the performance of ETFs and index funds. There are other costs associated with running a fund that are not captured under management fees. For instance, consider the cost of rebalancing the fund. As I mentioned earlier, both ETFs and index funds attempt to track a specific list of stocks. However, because of daily stock price fluctuations, both ETFs and index funds tend to get out of alignment with the index they're trying to track and need to be rebalanced on a regular basis. There is a cost associated with rebalancing a fund that is usually not reported. There are even more costs associated with running a fund. Those details are beyond the scope of this video, and I'm going to be discussing them in another video. The main takeaway here is that there are many types of expenses not reported as part of the management fee. These costs affect the performance of ETFs and index funds differently, and there's no easy way for investors to estimate their impact. The only way we can analyze the impact of these costs is by simply looking at the historical performance of similar ETFs and index funds side by side. Part 3, comparing the performance of index funds and ETFs. In order to see the impact of these different cost factors on the performance of index funds and ETFs, I decided to use Vanguard's Compare Mutual Funds and ETFs tool. This tool allows users to look at the historical performance of index funds and ETFs offered by Vanguard. When comparing different funds, it is important to look at the ones that try to track the same index to make sure that the comparison is apples to apples. There's no point in comparing the performance of an index fund that tracks the S&P 500 to that of an ETF that tracks the Russell 2000. Using this tool, I looked at the performance of these pairs of ETFs and index funds. The first pair tracks the total stock market, the second pair tracks the S&P 500, and the third pair tracks large cap companies. I'm going to add the link in the description box below so that you can also take a look at these comparisons if you are interested. I included the ticker symbol, the performance over the past 10 years, and the corresponding expense ratio or management fee here. As you can see in this table, all three index fund and ETF pairs had pretty much the same performance with similar management fees. The bottom line here is that the differences in terms of cost structure of index funds and ETFs have little impact on their long-term performance. I should qualify my statement by saying that this is true for index funds and ETFs tracking highly popular indexes. It is wise to stay away from crazy index funds and ETFs that track uncommon and esoteric indexes. Those types of index funds and ETFs usually have much higher costs and are not suitable for investors. I hope that you liked this video. If you have any recommendation or suggestion, please add them in the comment box below. Also, don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you don't miss any of my future videos. Thank you and take care.